Hi, this is Peter Schiff for the SchiffGold Friday market wrap. And we had another big week in the precious metals. Gold closed the week, I think, just around 3,643. We were trading on Friday morning above 36.50. I forget the exact high of the week. But one thing I did hear was that it was this week that gold finally took out its inflation-adjusted high that was set back in 1980 when gold was around 850 or something like that. So it's taken all these years to take out that high adjusted for inflation. Now, of course, it's not really adjusted for inflation. It's adjusted for the CPI. And the CPI dramatically understates the impact of inflation on prices. So I think if we had an honest CPI, we're still substantially below the inflation-adjusted high. So even though gold is at 3,643, it's cheap. You know, it may not sound cheap because it was a lot cheaper a few years ago, but in the scheme of things, it's still cheap. And silver is even cheaper. Silver closed the week at 42.16. That's a new 14-year high, but it's not even close to its inflation-adjusted high because silver traded at $50 in 1980. So it's not even back to its nominal high, let alone adjusted for inflation. So as cheap as gold is, silver is even cheaper. That's why I've been telling everybody to buy both precious metals, but in particular, buy silver. And if you are a SchiffGold customer, and hopefully you are, but you haven't bought any silver, what are you waiting for? You know, I've been pounding the table on silver for a while now. In fact, when it was at $30, I said that that was the floor, that $30 silver was like $2,000 gold. 2,000 was the resistance in gold, and it became support. And 30 was some solid resistance until it became support. Now the resistance, I think, is 50. But I think we're going to make a beeline for 50. There may be some resistance there because it's a double top, because we did get back up to 50 again in 2011. So we have this nice double top. But once we smash through it, that's going to be support. And I think it's going to be off to the races for silver. You know, on the week, the percentage gain for gold was 1.3%. But if you add the prior week, which was even bigger, we have a 5.4% gain in gold in 2 weeks. Silver was up 3% this week on top of the 3% from the prior week. So now 6% for the 2 weeks. So it caught up to gold. And what's really a positive indicator are the mining stocks, which were always a drag, right? A lot of people said that we're not getting confirmation of the bull market in the gold stocks. They're not leading. Well, now they are leading because the GDX was up 5% this week and the GDXJ was up 6%, even though gold and silver were not up nearly that much. And over the prior 2 weeks, you have a 10.4% move up in the GDX, which is the more senior gold stocks. And then the middle tier, the GDXJ, is up 12.5%. 12.5% in 2 weeks. You know, both of those indexes have now more than doubled on the year. So now we have the mining stocks confirming this move in gold. So we're firing on all cylinders. And what's really driving this leg of the bull market is the fact that we are going to have the biggest inflationary policies since the 1970s. Maybe worse, because it's not over yet. But the Fed is about to cut rates next week. Yet inflation is not only well above its 2% target, it's rising. Yet the Fed is going to cut anyway. This is something that's unprecedented with the modern Fed. We got the CPI report yesterday on Thursday, and it was actually a tenth hotter than expected. The headline CPI was up 0.4%. That annualizes to 5%. That's a lot more than 2. But more significant than the fact that we're way above 2 is the fact that we're headed higher. We're headed higher because a lot of the effects of tariffs haven't bled into the CPI yet, but also the Fed's about to cut rates. And that's going to propel prices higher. It's also going to push the dollar lower, which is going to increase what we pay for our imports, and which is also going to increase commodity prices. But the reason that the Fed is going to cut rates, despite the fact that inflation is well above target and rising, is because of the weakness in the labor market. Now, people who listen to my podcast or who follow me on X, they know that the labor market's been weak for the entire time that the Fed's been claiming it was strong, or the Biden administration took credit for the strength. I was calling out all these numbers as fake, and I warned my listeners that we would get downward revisions, and so that the initial numbers meant nothing, that they would all be revised substantially lower. And that's what happened on Tuesday of this week. The government came out with the single largest one-time revision ever to previous jobs reports. And the government revised down the jobs for the year that began in April of 2024 and went through March of 2025. So those 12 monthly reports were collectively revised down by 911,000 jobs. That's something like what, 68,000 jobs per month. That is not a small number. That is a significant number. 76. I got the math wrong. 76,000 jobs per month down. Now, of course, the original numbers had already been revised from where they were originally released. So these are just additional downward revisions on top of previously made downward revisions. In fact, I went back and checked, and of those 12 reports, 10 were originally, 9 were originally reported as beats. So 3 misses and 9 beats. And some of the beats were very big, right? We now know that only 2 of those 9 were actually beats. So in other words, 10 out of 12 monthly jobs reports came in below estimates. And not just a little below, way below. The beats were very small. The misses were huge. Had these numbers been reported accurately initially, the markets would have had a completely different reaction than what they did. And of course, Jerome Powell wouldn't have been able to be talking about the incredible strength and resiliency of the U.S. labor market, because it would have been apparent that we had a weak market. And in fact, what's even weaker is the quality of the jobs. All of the jobs that were created during that month were in government or government-related jobs, like healthcare, social services. The private sector actually lost jobs. We destroyed private sector jobs for the entire year. The Fed was bragging about how great the labor market was. Right? When you're losing private sector jobs, those are the jobs you need. That's your tax base. Government jobs don't support the tax base. They drain the tax base. Government workers don't really pay taxes. They get tax revenue. Even if they give some of it back, they don't pay taxes net. They get money from the government. The government only gets tax revenue from the private sector. But those jobs were destroyed. But it's not just the erosion of the tax base, and that's also why the budget deficits are skyrocketing, because the private sector jobs that pay taxes to the government were being lost, not created. But those private sector jobs are productive jobs. They result in goods to consume or services. But the government jobs, by and large, just produce red tape. They just make the private sector less efficient, right? They gum up the works. So if we're adding government jobs and losing private sector jobs, that's a bad thing. right? I'd rather not gain the government jobs at all. So if we had fewer jobs, but fewer government jobs, we would be better off. But we got the worst of both worlds. We lost private sector, productive, tax-paying jobs, and we gained non-productive government tax-sucking up jobs, right? So the labor market is very weak. That is why the Fed is about to cut. But the problem is the cuts are not going to help the weak labor market. In fact, they're going to backfire and make it even weaker because the Fed is now cutting rates into a rising inflation environment where the world is already losing confidence in the dollar and the Fed and is de-dollarizing. That's why the price of gold is at a record high and continues to rise. This is a very different environment than the last few times that the Fed tried this. And I think the Fed just assumes that the stimulus is going to have the same effect that it had in the past, and it won't because circumstances are different. The rate cuts are basically going to pull the rug out from under the dollar. I don't believe that the rate cuts are going to lead to a decline in long-term interest rates or mortgage rates. In fact, I think we've already seen that decline. And I think when the Fed does cut rates next week, long-term rates are going to go up. Mortgage rates are going to go up. And that is ultimately going to be the catalyst for a return to quantitative easing and ultimately yield curve control, where the Fed, probably under the direction of the Trump administration, because Trump is now taking over the Fed, basically hijacking it and destroying even a pretense of independence. You know, I don't think the Fed was ever really independent, but at least we pretended that it was. But now we're going to drop the pretense. And, you know, I'm not a defender of the Fed. I've been a big critic of the Fed. The Fed has been a big part of the problem. But letting the Trump administration control the Fed doesn't solve that problem. It actually makes that problem worse. So the Fed is going to go from bad to worse with Donald Trump controlling it by putting his minions at the FOMC and basically, you know, affecting this control. Because what Trump wants to do is drive down interest rates, get the Fed to crank up the printing presses to try to reflate a bubble. See, Donald Trump realizes that to have real economic growth, the policies that we need to get there are politically unpopular. And as a populist, he doesn't want to do something that's politically unpopular. Also, to really make America great again and fix what ails us, we have to go through some short-term pain. We have to take a recession. We have to see a drop in asset prices, a rise in interest rates. That's going to be problematic for a lot of businesses, for a lot of individuals. And that's not what Trump wants on his watch. He doesn't want to go through any short-term pain, even if it brings about long-term gain, because he's worried that, well, he won't be around to get credit for the long-term gain because, you know, he's got 3 years left of his presidency. So he doesn't care about 10 years from now. He cares about the next few years. And what he wants to do during those next few years is blow more air into the bubble. So he wants the Fed to crank up the printing presses. And so this is going to be massive inflation, but it's going to be stagflation because we're not going to get a rebound in the economy as a result of all this extra inflation. Because in the past periods where the Fed created a lot of inflation, it didn't do the damage that it's going to do this time because we were able to export that inflation to our trading partners who bought up the dollars and then reinvested it in our treasuries. And we were able to continue, to get the stimulative benefits of the cheap money without the negative consequences on consumer prices and long-term interest rates. Well, now we're going to have to eat our inflation because not only are foreigners not going to want to buy up all these extra treasuries, but the tariffs already complicate the ability of American consumers to afford to buy foreign products anyway. And so because of this, they have even less incentive to try to prop up the dollar to enable us to buy products that the tariffs have made unaffordable anyway. So the United States has made itself far less relevant in the global economy. And so our trading partners who have been carrying the load for us, who have been loaning us all the money and supplying us with all the goods, they are going to not have the same incentive to do that. In fact, they're already trying to divest themselves of dollars. So this is going to backfire. It's not going to be stagflation light. I hear some people talking about, hey, maybe we've got stagflation light. We have stagflation heavy. We're going to have a weaker economy than the 1970s, but we're going to have stronger inflation. In fact, the inflation is already stronger. It's just that a lot of people don't know it because we're not using the same CPI that we used during the 1970s. If we were still using the 1970 CPI, we wouldn't have 5% inflation. We'd probably have 10% inflation, which means we actually have 10% inflation. We're just pretending that we don't. Yet despite this, the Fed is about to cut interest rates. And again, I think go back to quantitative easing. And the other big difference between the 1970s and today is that in the 1970s, we weren't broke like we are today. In the 1970s, the U.S. was still the world's largest creditor nation. We had large trade surpluses in manufactured goods. We didn't have a huge national debt. It was in, the hundreds of billions. And, our total debt to GDP was very small. And most of our national debt was financed, with long-term treasury bonds. We didn't have a lot of short-term bills that came due as, we ended up jacking up interest rates in the late 70s or early 80s to put that inflation genie back in the bottle. We had the ability to raise interest rates substantially without it impacting the entirety of the national debt. It was mainly just the new borrowing. But today, we're in a much worse fiscal and financial position. We're the world's biggest debtor nation. We have huge trade deficits. We've got over 37 trillion of debt. And the national debt is financed heavily with short-term bills, which makes it nearly impossible for us to do what Volcker did. Because if we tried, we'd be broke because we couldn't afford to service the existing debt as it matured, because it would have to be rolled over into that much higher interest rate environment. But we're not even there. We're not even going to start to try to fight this inflation. We're cutting interest rates in the face of rising inflation. So rather than fighting inflation, we're fueling the fire. We're pouring on gasoline. So the markets are sensing this. That's why you're starting to see this move up in gold and silver. And I think it's going to accelerate once we start getting these rate cuts. I don't think it's going to be a buy the rumor, sell the fact when it comes to gold and silver, because they haven't even bought enough gold or silver considering what the Fed's about to do. And I also believe the economic data is going to continue to come out weak despite the cuts, but the inflation numbers are going to keep getting stronger, and the Fed will continue to cut in the face of that. It will explain the numbers away. Maybe it will attribute it to the transitory effect of tariffs, although they probably won't want to use transitory. They'll probably have to come up with a synonym for it because they really got in trouble the last time. But effectively, they're going to be saying the same thing. And of course, once Trump takes control completely of the Fed, once they get rid of Powell and they have a new chair, there's no way they're hiking rates on Trump's presidency, no matter how high inflation goes. Maybe they'll have to fire somebody at the Bureau of Labor Statistics or whoever computes the CPI to make sure that they rig the numbers so that the public doesn't even know the truth, even though they're not getting the truth now. They're getting spoon-fed a lie, but it may be that inflation is so high that even the rigged CPI is still going to be unacceptable, and so they're going to have to do something about that. But in the meantime, you need to buy these metals. I would not wait for the rate decision. I don't know if they're going to cut 25, 50. There's some argument. I mean, it's no longer about will they or won't they. It's pretty much a foregone conclusion they're going to cut, and they're going to cut again before the end of the year. So the only debate now is the size of the cut and how much they're going to cut. Nobody is debating the fact that they should be hiking rates, which is what they should be doing, because of the two mandates, employment and price stability is the more important. And in fact, Fed Chairman in the past, including our current Fed chairman, have said the best way to achieve your full employment is to make sure we have price stability. That if that's lost, then the other battle is going to be lost too. Well, now we're just conceding that because we're going to ignore rising inflation and we're going to try to stimulate the labor market by creating more inflation. But that's going to sedate the labor market because it's going to drive up the cost of living. It's going to drive up long-term interest rates. It's ultimately going to destroy purchasing power and lead to job losses, not job gains. So Powell is going to actually make a weak labor market weaker, which is going to be a self-perpetuating stagflationary spiral. And the main benefit of that is going to be precious metals. So again, SchiffGold's website is working all weekend. You don't have to wait till next week. You can buy some gold and in particular buy some silver. Yeah, you're paying over $42 an ounce now. Well, if you didn't buy it last week or the week before, it's your own tough luck. You shouldn't have waited. But you know what? The bigger mistake than not buying last week or the week before is not buying this week. Right? And every week I do one of these, it's going to be to remind you of the mistake that you made by not buying the prior week, right? Stop worrying about buying the high. Just buy the high, because everybody who buys the high, is, I think, going to make money because the highs are going to keep going up. And the people who are looking to buy a big pullback are just going to be standing on the sidelines, while the train not only leaves the station, but makes its entire journey, or maybe the rocket ship, makes it to the moon. So stop worrying about trying to nickel and dime this thing and just get on board, right? And if you want to talk to people, we have guys standing by. You can buy directly on our website, or you can, talk to the precious metal specialists, and they will help you. But I think if you wait for the actual rate cuts to happen, you could end up being at a higher price. And who knows? I mean, $50 silver is not too far off. And neither actually is $4,000 gold. We're closer to 4,000 than 3,000 now, in case you haven't noticed. And I think once we go through 4,000, it's not going to take long to get to 5,000. And again, it's not really precious metals that are going up. It's the value of the dollar, the fiat dollar, not the real dollar, which is a weight of gold and silver, but the Federal Reserve note, which isn't even a note because it promises to pay nothing, but that's what's losing value. And the Federal Reserve and the Trump administration is going to guarantee that the dollar loses value even faster in the future than it has in the past, which means the price of gold and silver will be going up faster in the future because it's going to take more and more of those devalued dollars to buy the same quantity of gold and silver. Enjoy your weekend, and I'll be back again next week.